we basically stopped at
the activity there. Yep.
With these activities, and I think with that, you know, you have requirements, and you know that part. The other sections that the other areas that you need to have an understanding is basically a little bit about, you know, what are the documents or the records that are critical to auditing. I mean, we did talk about this at the beginning. I mean, the balance sheet and the income statement and profit and loss and so on. But maybe tomorrow we will have more time to talk about how these accounting records are connected with the auditing process.
Okay. All right.
So I just copied these content because it gives. I mean, these are the critical or the main matter that the auditors are looking at, right? They will look at the cash book, right? How the money is received and how the money is expended, and a record of assets and liabilities. So companies keep a record of their assets and liabilities. Now some companies, they have their own accounting system. And you know, sometimes it's a very basic manual paper-based system where they keep sort of, you know, they write down all the transactions, daily transactions, and they have, you know, printed bills, and they, you know, write them, and they have a carbon copy, you know, that stuff. And they have books which they keep records of things that happen with things that they buy, and you know, the assets and all of that. So that's a very crude and basic system. And then some companies have upgraded themselves into a digital platform. Like you have like QuickBooks and, you know, some basic cash flow kind. There's a system called Cash Flow which we use. So they used to be sort of software that's installed in computers, but now you have those softwares as browser-based softwares where you sort of log in online and you record all your transactions on that system, right? So you create invoices, and then you send the invoices through the system. And when the money is received, it is recorded and the receipts are sent, and then you create purchase orders on the system, and so on. And then you do bank reconciliation every month, etc. So then the system automatically records all of it, and then when you press a button, it generates these reports whenever you want them, right? So you know, we see that fairly developed or companies doing that. Sometimes they do it by having their own accountant in-house, and sometimes they outsource it to somebody else.
Yeah. Okay.
But then you have large organizations like the British Council that I work for. They have, you know, very large, complex software that's connected with ERP systems. You know, you have platforms like SAP. What is the accounting platform that you guys use in your
SAP.
SAP. There you go. So that's like a global giant, and the top companies use that. It's a very expensive platform. So you have a range of software that where you sort of do your accounting system and other systems all interconnected, and then you have these records, right? uh, so uh, yeah so the accounting records must be sufficient to disclose with reasonable accuracy at any time the financial position of the company at the time. So that's the idea here, that the so if you maintain a system of whether it is manual or online, digital or whatever, it should be able to reasonably give you accurate report, a record of your business, right?
Okay.
Yeah. So then the statutory books a Companies Act requires the company to keep a proper accounting records, obviously, a register of directors and secretaries. So there needs to be a company needs to always maintain a register of their directors. These directors, as you know, can be executive directors as owners and non-executive directors. Then who are your company secretaries? A register of charges, so your liabilities, the money that you owe to other people, right? A minute book of the meetings. So when the directors meet, meetings, the minutes needs to be maintained, and usually the secretary needs to sort of sign it off. An index register of members. So members are like they can be shareholders. Sometimes in a guarantee limited company, we call them members as well. So who are they? Index of registers of each director's interest in shares and debentures. So all that information. And if it is a public company, all a register of all the shareholders who have an interest of 3% or more in the nominal value. So that 3% or more could change from country to country. Small scale share owners information might not be necessarily kept, but people with large sums of shares, their information needs to be maintained, right?
Okay.
By law. So these are the kind of accounting records that that are critical and essential for auditors. So the accounting principles that an auditor will use is the going concern. Do you know what is meant by going concern?
Not exactly. Maybe you can brief me a bit.
Yeah. So what that means, Kira, is the auditor will assume that the company is ongoing.
Okay.
Right, and that the company has the resources, mainly like financial resources, for it to run beyond this current year, for example.
Okay.
Right, that the business is running, that it is it can stay afloat, and it is not going to go bankrupt next year, right? So that's the meaning of going concern.
Okay.
Sorry. Then Also consistency, that the auditor will apply consistency. I mean, the organization needs to have consistent accounting to start with, right? I mean, if it has like, different branches, different departments, different SBUs, they themselves need to have consistency.
Okay.
The auditor themselves need to have consistency across the company when they're doing their auditing, right? So this does not mean that, like, if the auditor decides to check the certain transactions at the procurement department, for example, that he or she will have to do the same with HR department, marketing department, everybody. That's not what it means, and you will understand that when we go a little bit further. What it means is that the auditors, let's say, scrutiny, level of scrutiny, or if the auditor is applying a certain level of materiality, then those limits will be applicable consistently throughout the organization. That's what it means, right? I mean, generally, that the auditor needs to be consistent, right, in their auditing process.
Okay.
And they also need to be prudent and conservative, in the sense that they should not take things for granted and be laissez-faire and hands, oh, it's okay. That's not the approach. That they have to be conservative. They need to assume that things
Even for the small tiny details of it.
Yeah. But again, we will come to that slide, and yes, you have to be conservative and you have to be prudent, but obviously you can't be like crazy prudent, in the sense like you can't check every transaction. That's impractical, right? You have a limited time. Usually the audit happens towards the latter part of the year or immediately after the financial year, and there's a very limited window where you have to do your audit and then prepare the report and present it. So depending on how big the organization is and the number of transactions and the geographical spread. Remember, I told you that if there are so many branches, it's very difficult to be difficult to check everything. But it is more like whatever way that you plan to do the audit, you have to be prudent. That's what it means, right?
All right.
Like, for example, if you decide to say, okay, we're going to take random samples of transactions, then you have to be prudent there and assume that there could be issues. And then another very important thing is the principle of accruals, that you use the accrual concept. Are you familiar with the accruals concept?
Yeah, pretty much.
What does that mean?
Basically for accrual is like what we accrue before actually end of the month. Normally that's what I do. Like we have to accrue how much we're gonna be receiving or paying by end of the month. It's like total expectations, something like that you're supposed to receive or to pay.
Yeah. So what normally happens is when you make a transaction, if you are to like if you sell something, if you sell a product, if it is a over-the-counter transaction, you make the sale and you get the money at the same time,
Correct.
right? So that's very straightforward. But as you know, in modern business practices, you know, a lot of transactions happen. The sale is made, but the time that you receive the money is not at that time. It happens at a later time. Right? Yes. That could be because of certain credit arrangements, corporate agreements. You know, imagine if a company is buying a large stock, you know, they would get a credit period and so on. And sometimes if it is a bank transfer, then it will take time. So there's always a time that from the time that you make the sale and the time that you're going to actually receive the money. Right? Okay. Now, in the olden days, the transaction was actually recorded. The date of the transaction was recorded as the time that the money was received. Okay. Right? But that is not a very good way of recording business, because the transaction actually happened on this day, right? Oh. It is due to various other reasons that the money is coming at a separate time, right? So what the accountants did was they adopted this accrual concept and said that you need to record the transaction at the time the transaction was made. Right? Okay. So even if you're going to get the money in 1 month's time, that is a separate matter, right? That is, you know, that the collection of money is a separate matter. On the systems, on the accounts, you're going to record the transaction on today, right? Yep. Same way, the other way is, can you hear me, Kira?
Yeah, can hear you.
Can you hear me, Kira?
Yes, I can hear you.
So the other way is that when you when you buy something, you might not pay at that time, right? The money from your bank will go at a different time, but you will record the transaction of the purchase on the day that you actually purchased it.
Okay.
Right. So stuff like, you know, sometimes you sign an agreement of some kind of a business deal. That is the day of the transaction, right? The monies will exchange at a different time.
Yep.
So this is the idea of
accruals.
On the other side, realization, right?
Because for me right now, we have like the agreement with the customer. Actually, they do have a credits and they could pay within 35 days payment term. So I think that's a normal accruals that I was doing, because we have to calculate how much we're going to receive by end of the month, depending when the payment terms is actually due.
Yeah. So actually collecting the money it becomes another part. Yeah. And if it doesn't get collected, then, you know, there will be a record of that. And what you will find is that in the audit process, so what they will do is they will first look at the transactions, you know, the income and expenses. Okay. And then they will track those numbers with the actual monies being received and going out, usually from a bank account, right? So for that they will use the bank statements, And that's why you usually have to do bank reconciliation as well, right? That's like one of the main reasons why you do the bank reconciliation. Your system will like it as such, and this month's bank statement should show that money in your bank.
Correct.
Right?
Because we do have a bank reconciliations, and also we also have reconciliations with the AP team with these customers. So yep, kind of get the point.
Yeah. So you understand this idea. So the auditors will also do this tracking, right?
Okay.
And when the monies came, did the monies actually come, all that, right? Sometimes what happens is the monies don't come and they end up as bad debts.
Yes.
Right, and then you will have to make adjustments in the system, right? You'll have to make records and you know, name them as bad debts, and then you'll have to waive them off, and waiving them off requires authorization, so on.
Yeah, we for us, like normally anything more than 360 days, we just gonna go and write off for it, because it's hard to process an invoice that already due for a year from the date.
Yeah, but before that, I think you will have a series of actions, right? I mean, you will have to write to the customer. You need all the evidence to show that.
All those dunning letters and everything first before that, before we proceed with stop credit and also write off. But it has multiple layers of it, the process, depending on the period of the due.
And also the amount, I suppose.
Yeah, correct, exactly.
Yeah. So all those things, so if say, for example, if an auditor picks up something like that, the auditor will want the information, right? Okay, what was your process? What is the process that you followed? Now, that process is actually something we call internal control, and we will talk about it in a bit. Okay, so that you will have some kind of a process, some kind of controls within your organization to prevent from a transaction ending up as a bad debt, right? And different companies will have different strategies, right? Some companies, depending on the amount, they will have various actions and the level of personnel that gets involved in it, right into the customers and getting involved with the customers. If it is very high, you know, then the authority goes high. And you know, it goes to the extent of legal litigation, right? I mean, imagine like if it is a bank and if it is a mortgage and if it is not paid, then the bank will take legal actions and so on. So you know, all those records and then the letters being sent via registered post, and you know that process. So that process, how many times you have to send the letter, blah blah blah, all that. So those are called internal controls.
Okay.
Right. And one thing that the auditors will always look at is are these internal controls and how good they are. Right. Because the idea is, if the internal controls and the accounting system altogether, if that system is pretty good, right? If it is strong, if it is obviously no system is 100% perfect, but if it is really good, and if they find evidence to show that the system is really strong and good and is followed, then the auditor's job gets easier. Because the auditor then assumes that because the system is good, what they need to do is just check the errors and issues of the system, and not the individual transactions underneath that, right?
All right.
So I will come to that in a bit, but so along with this, we have these accounting standards. usually be a common like phrase of standards is statement of accounting standards, SAS. But I think the latest version is called statement of financial accounting standards,
Okay.
which is prepared by the Financial Accounting Standards Board, an international organization. And then you also have international standards of auditing, particularly, for sort of targeting auditors, and it has been developed by the International Federation of Accountants. Right?
Okay.
So these are some of the most basic accounting standards that are being used, and they complement the GAAP and the international accounting practices. Okay, so this is something that we have. This is one of your assignment questions as well.
Yep.
Rules of professional conduct. So we'll have to spend a little bit of time talking about these matters. And I think probably the biggest part of being an auditor, apart from having knowledge of accounts, is to do with all of these. Right? I mean, think about it. The job of an auditor is it's a tricky one, isn't it?
Yep. Very.
I mean, you're required to give an opinion of truth and fairness. Again, very abstract concepts, right? So an auditor is in a very unusual position of how to do that, right? So just by having knowledge of accounts, just by being chartered accountants, is not enough to be an auditor. So that's why a large part of being an auditor is to do with the professional conduct. Right? So let's go through one by one.
Okay.
You have fundamental principles. I mean, I sort of broke them down like this: ethics, independence. What are the conflicts of interest that could occur? How do auditors advertise and publicize themselves? How do they obtain professional work? And that'll kind of answer the question that you asked last week.
Yep.
How do you find auditors? Remuneration. How do they get paid? And stuff like insider dealing, money laundering. Implications of that, and what is whistleblowing, and some other matters. Right? Once again, I apologize for the text-heavy slides, and they are boring. They're just on a white background.
It's all right, no problem.
But hey, auditing is a bit boring job, and it requires a lot of reading and going through numbers and words and letters and reading a lot of things. In fact, it's one of the the very first thing that an auditor would do is to collect what you call working papers.
Okay.
So they collect all kinds of data that they can lay their hands on, anything and everything really. Previous audit statements, published records of the company, historical performances, industry. I mean, if the company is in banking and finance sector, then the industry information. If it is in certain manufacturing, then that industry information. anything, future prospects, all kind. They just gather a lot of information, and then they talk to people. They get testimonials, interviews, and questionnaires. So an auditor looks at a lot of data, and we will talk about the stages of an audit process, the planning of the auditing also later. Okay. So let's very quickly, go through these points. Members should have with integrity in all professional, business, and personal financial relationships. Integrity implies not merely honesty, but fair dealing and truthfulness. So this is about integrity, right? It's not just about being honest, but also being very fair to everybody, and being very truthful in all instances. And they should have objectivity. They should look at things from an objective mind in all their judgments. They cannot favor they cannot be subjective in their judgment, right? Intellectual honesty. And members should not accept or work which they are not competent unless they obtain such advice and assistance from somebody who has it.
Okay.
So if you are not really competent in auditing something, then you should not do it, right? Sometimes you might be asked to do an HR audit. If you don't have the competency to do it, then you should say no. Right?
Okay.
If not, you have to take advice and assistance from experts who have that expertise and the knowledge and the competency of doing that. Right. So that's another important thing. Just because it is business for you and it is income for you, you should not take it if you don't have the competence. Because this is serious stuff. I mean, once you audit and once you give your opinion, then that becomes, people depend on that after that, right? People trust you, trust your judgment, and people will make decisions based on your judgment. And there are instances where audit firms have been taken to courts for losses that were made because of the auditor's opinion, but not because of the fraud. I mean, it is the auditor's failure to identify the fraud.
I see.
And that could be an issue for auditors, right? And members should carry out their professional work with due skill, care, diligence, and expedition, and with proper regard for the technical and professional standards expected of them as members. So auditors are it's a very serious thing. You will usually find them to be, they're not very friendly people, right? And there's a reason for that. They cannot be friendly, right? They can't be. You'll find them kind of emotionless people when they come and talk to you, right? Because they have to maintain that consistency, that objectivity. They cannot get they cannot give any kind of wrong cue through their behavior. So they try to be they look and sound like they're very serious, emotionless people. They don't usually smile with you. They don't agree with you when you say something. They will not nod, right? Just like how we do in our basic work. even if they ask a question, they will ask that question with a blank face, and they will listen to the answer with a blank face, and you don't know whether they actually believe you or not, right? I mean, when you normally answer somebody, you have a fair understanding that the person is actually believing what you're saying, right?
Yeah,
The person will agree or whatever. They will not have that kind of attitude. They will be just very blank, and for them,
I went through that with my previous company during the audits. So I kind of get it, because when I was explaining, that person's like, you cannot explain to the wall because there's like no response, no yes, no, like, did you get what I'm trying to say? But he asked the questions. When I give the answer, it's like, like you're giving answer to the air, like nothing, no response. But I kind of understand now that they have to maintain that integrity between them, like not to give any bad clues or anything.
Exactly. So it's only fair that you they behave like that, and I'm sure it's a very difficult thing for them as well. I mean, they are humans after all, and for them to sort of maintain that that attitude is not easy. But anyway, it's part of their job, and members should behave with courtesy and consideration to all with whom they come into contact during the course of performing their work. Yeah, courtesy. Courtesy, again, it's a very abstract term.
Yes.
I think common courtesy, maybe they can say thank you if you give an answer, but they would never say, wow, that's really good, well done for doing that, right? Even if you have done something really good and you explain it to them, they will never say, wow, well done, that's really good, excellent work. They will not say that. They will probably say just thank you. That's the courtesy that you will get from them, right? And that's all we can expect from them as well. So in terms of ethics, again, a very broad topic. But for the purpose of auditing, professional accountants are required to observe proper standards of professional conduct, whether or not the standards required are written in the rules or unwritten. So, being ethical is not, you're being ethical not because you are required to be ethical. As a professional, you make a choice to do the right thing, right?
Okay.
And that is not only for accountants. Hey,
it's for everyone.
It's for everybody, right? I mean, if everybody is ethical, then the need for an audit is lower and lower, lesser and lesser, right? The reason why we have to audit is because the assumption is that not everybody is ethical.
Yep.
And they're specifically required to refrain from misconduct, which is difficult to define precisely, as it says. But they should not do something which is likely to discredit themselves, their professional body, and the profession altogether, right? If an auditor, if an accountant violates the best practices and ethics and the professional guidelines and conducts and rules, then they discredit themselves. If they are chartered accountants, then their body, right? So they say, oh, the chartered accountants of Malaysia, they have these kind of people, right? They will bring discredit to the body and to the industry as well, right?
Okay.
So so every individual, every accountant has an obligation beyond themselves. So the whole idea of ethics is kind of what enables all of these other things, isn't it? I mean, if you don't have a strong sense of ethics, then all these other things are irrelevant. Professional independence as an attitude. Yeah, so you're a very independent person. Integrity is vital. Yeah, synonyms for integrity includes honesty, uprightness, propriety, moral soundness, rectitude, Okay, what's independence? An auditor must always approach his work with integrity and duty. Okay, matters of concern. Now, if you have some kind of an undue dependence, right? If you're under obligation to your client in some way, that is going to take away your independence, right?
Yep.
And we will look at an example in a case study shortly. Like if a large part of your own income, an auditor's income, comes from one client, like let's say the annual turnover of the audit firm is $1 million, and you know $500,000 comes from one client.
Okay.
Do you see a problem there?
Yep. Yes.
Yeah. There's an undue dependence on that client, right? Family or other personal relationships. So if the client is related to you, that also takes away your independence.
Yep.
Beneficial interests in shares and other investments. So if you are a shareholder of a particular company, and if you have made investments, if you have given loans or whatever to that company, then obviously there's dependence there. Acceptance of goods and services as gifts. Now this is a very tricky area, right? Now the ideal scenario is that you don't accept any gifts from your clients, right? Now I remember one example when I was working with the British Council. There was a practice, Kira. It was like a tradition, right? Which has been there for ages, that every year during the Christmas holidays,
Okay.
all the managers are asked to prepare a list of their top contacts, right? In your case, you would call them top clients, right? Or service providers, or partners, top partners, whoever, right? And then you will send them some gifts, right? So you send wine bottles, chocolate boxes, right?
Yep.
Seasons, greetings cards, whatever. Depending on the importance, you send different value gifts. Now that was a tradition, but then in an audit, well, there was a new country director who found this tradition a little unusual because it was not there in many other countries.
Okay.
And he questioned it, and then through further discussion and consultation, it was decided to completely stop that practice, right? I think I agree with that decision. I think that's the right thing to do, because especially as a cultural relations organization, a development agency, when you sort of send these gifts, it kind of questions your, as a charity, if you are able to send gifts, right? Then how is that a best way of putting, using the money that you get? And secondly, it kind of creates an undue
dependence there.
dependence and a relationship, right? I mean,
Yes.
when they receive, when one of your clients or one of your partners receives a gift, that kind of crosses the professional boundary and goes to the friendship boundary.
Yep.
And they would feel unobligated to do it, and especially if they didn't ask for it, right? and you see this happening in many instances where people send gift hampers during holiday seasons and so on. And
Yep.
this sometimes it's a cultural thing. These countries, especially in our countries, Asian countries, we have this sort of gift giving culture.
Gifting season.
Yeah, it's fine, but it can lead to problems.
Understand.
So auditors especially should refrain from receiving goods and services as gifts, right? They should not get special discount for whatever, right?
Yep.
They should reject if at all, if they are offered with something. Maybe a thank you card or a season's greetings is fine, but not more than that.
Yeah, but not items and everything. Because I remember last time when we have an audit, it's like not even to treat them for lunch at all. It's like it's a way no. So you can show them where's the shop, but it's totally up to them where they going and who's they need to pay on their own. Like you are not to be interrupted. Like because normally if you have a guest coming to your company, like partners or anything, you would definitely bring them out for lunch just as a gratitude or anything. But for auditors, it's strictly no. It's like there is shop, then yep, you can go.
Well done. That's I forgot about that, and I'm glad you reminded that. Exactly, that's exactly what it means. Yeah, and provision of other services. So if your company is providing too many services to the client, that could also lead to a dependence problem. Commission fee or other reward from a third party as a result of advising a client, right? So like, let's say for example, if there's some agency that is going to benefit as a result of the advice that you gave to a client, and if that agency is going to give you something for that,
Okay.
right? Clearly that's unethical. I mean, if that agency is going to benefit from it, then that is because of your professional work, not because you wanted to help that agency, right? So, as you know, less tax or whatever it is. So anyway, you get the point there very well. And then what are the conflicts of interest that could arise? There can be conflicts between an accountant and his or her client, right?
Okay.
For the reasons that we discussed earlier. There can be conflicts between two or more clients of the same accountant, right? So if you have two clients, and if these two clients have some kind of ongoing legal battle or competitive market competition or something like that, and if you are the auditor for both these clients, there can be conflicts there.
Okay.
Right? If they are market rivals, and if you're providing audit services for both of them, then that questions whether you can be strictly objective, right?
Could you like in details, like, I mean, for an auditor, right, you have the integrity to audit both company. How does it really make a conflict exactly?
So as an auditor, you will be privy to all the inside information of the client, right?
Yep.
Now, of course, you can maintain your professional conduct, and you can say that, hey, this this information is strictly confidential. It's not going to go out to anybody, any third party, let alone the rival, right? You can maintain that, right?
Okay.
But from the client's perspective, and any other agency's perspective who has a vested interest in this rivalry, it may not be so.
Okay.
Right? Because they like, one argument could be that, like, you know, if you give an advice to one of the clients, right? Are you then ethically bound to give the same advice to the other client, although that advice did not come from the audit of that client?
Okay, understand.
You get the point?
Yep, now I get a point.
So the auditor, as much as would try to be, you know, objective and independent, there could be an issue for in the process of auditing, but also in the eyes of the others as well.
Okay, interesting.
Right. So it's generally better to avoid clients who have conflicts between them. And especially if there's, you know, legal battles between clients, it is better to avoid them altogether.
Okay.
But you as a manager, this gives you an implication of how to select an auditor.
Okay.
Right. So when you're selecting an auditor, this will be one of your concerns, right? Are they auditing their rivalry or companies with conflicts? And then a question arises: can you ask that question from the auditor? And is the auditor required to divulge that information? Usually it is, because if they are large enough organizations, then when you publish the auditor's report, then you know who the auditors are. Right? So then maybe you can avoid them and go for auditors who are not in your rivals, who are not auditors of your rivals.
Okay, understand.
So specifically, you know, there are some examples here: provision of other services to audit clients, preparation of accounting records. Practice should not report if they're associated with the company secretary. If sometimes the firm, the audit firm, we don't call them auditors, you call them accountants, but this accounting firm, if they're providing the secretarial services, the acting as the secretaries of that company, they should not take the auditing job. Also, these two things should be kept separate. So you need to have one company as secretaries and another. They're not called companies. Usually, these are not called companies. They're called, you know, especially secretaries. They tend to be lawyers, and so they are a partnership most of the time. So you keep them separate and you keep the auditors separate.
Right.
Employee of a client during an accounting period or in the previous 2 years must not take part in the reporting function. So if you have an employee, like if you're the auditor, and if you have an employee who has worked in your client's company during the last 2 years, is still working in the company, like, you know, maybe taking a part-time job or whatever, that person should not be involved in the auditing of that particular client.
Okay.
You can put that person to some other client, but not for that client, right? So receiverships. So what's meant by receiverships is like when companies go in, sometimes they go into financial trouble. Right? they're not yet bankrupt, but they may be sort of heading towards that. And when that is sort of identified, sometimes it could be as a result of, like, there are creditors and these lenders are trying to recover their money.
Okay.
And the company is struggling because they are not getting, they don't have the income, or they have gone to some kind of fraudulent activity and they have lost money.
Okay.
So this goes to the courts, and the court will appoint some agency, and it is called receiverships, right? Or the receivers. So what they do is they will take hold of the company as a short-term measure, and they will help the creditors recover their money.
Okay.
And we also help the company to sort of get on track.
All right.
Right. So there are some examples in the recent past in Sri Lanka that I can think of. There was a large, like a conglomerate, and they had financial institutions, right? They had like banks and finance companies and so on. And the whole conglomerate fell apart. But also there was this one bank that was falling apart as a result of the whole group's collapse. And the central bank intervened, and this is my son playing his Xbox. Can you see that notice on your screen as well?
Yes.
Yeah. My son is being invited by his friends to play Xbox, but he's not allowed, so they keep on asking. My account is connected to his account because I need to keep an eye on what he's doing. That's why these messages pop up. Apologize for that.
No problem.
So Kira, so I remember, so then a new board was set up, and it was sort of in the central bank intervened and helped the some of the people who lost the money to recover that money, blah blah. So that process is called receiverships, right?
Okay.
And sometimes the company goes into liquidation, it's bankrupt, it is liquidated, the assets are liquidated, and then the creditors are paid and so on. And audits within a 3-year gap. So if a firm has taken up a receivership or a liquidation or an audit within the last 3 years, right? They should not take an audit again. Yeah. Right. So these are the types of conflicts of interest that can arise.
All right.
All right, so this is kind of tied to the question that you asked, how are you going to find these auditors? They need to advertise themselves, but they can't advertise like anybody else, right? They need to be extra cautious. They should not bring disrepute to themselves, the member of their professional body, or the general profession. They should not bring discredit the services of others by claiming superiority. So you got the PricewaterhouseCoopers can't advertise by saying they're the like better than BDO or better than KPMG or whatever. So they can't compare themselves with others and put the others down.
Okay.
Right. Whereas in normal business, they always do that, right? Coca-Cola advertises as superior to Pepsi, and Pepsi advertises.
Everyone is like the #1 brand in the world.
Yeah, everybody's there. Everybody's the best. So they can't compare. They can't compare between other agencies. They can't be misleading, obviously, directly or by implication. They fall short of advertising standards authority as to legality, decency, honesty, and truthfulness. They should not fall short. Adverts may refer to the basis on which fees are calculated. However, no hourly or other charging rates are permissible. So you can't advertise your hourly rates, right?
Okay.
And you can't say a special discount for April or whatever, right? Seasonal discounts, you can't say stuff like that, like how others will advertise. So an audit firm is they can't advertise like anybody else. That's the bottom line.
Okay.
This kind of leads to this publicity. In the past, of course, accountants were required to be anonymous in public matters. Like they maintain a very anonymous status in public matters. They don't sort of make comments using their names in public matters, right?
Okay.
But now it is less restrictive. They have given an example here. An accountant appearing on a chat can introduce himself as John Ticker, certified accountant. That's acceptable. But if he can't say that he's a Satanist, right? Or Satanist, how you want to call it. You know, that's going to create an issue with his profession. So how this is about how an accounts firm make public statements, right? Whether on government. I mean, you may have noticed this, like when the government has taken some kind of a decision on some public matter, maybe it's a new law, a new constitutional amendment, or some kind of a new project or something like that. You find certain audit firms writing it, but they are very, very careful in their language, isn't it? They don't explicitly say that this is bad, this is good, this is wrong, this is right. They're very careful. They analyze the pros and cons, and they just leave it at that, right? Or they just give the data that is required for us to analyze it, and we just leave it at that, right? That is because they cannot, that auditors are very, very careful in making public statements on public matters, because then that would mean, I mean, then one could infer that they are biased to one government or a political party or some institution or something. Right? So they should not be seen as agencies trying to whitewash companies. I mean, there was a big issue in Sri Lanka. It is notoriously called as the bond scam.
Okay.
The Central Bank of Sri Lanka was found, the central bank governor, the then governor, was found to have been dealing with some inside information, and we are coming to that. And, it became a huge problem, huge political scandal. And then we did see like accountants and accounting firms writing about it, but they never made comments about the governor or the government's decision, etc. They just gave the numbers. that was it, right? So it's not easy for accountants, and especially in the process of audits, to be public facing. That's why you find these audit firms are very low key, and it's not easy to find them. Also, you search on internet, you search Google, okay, audit service providers in Malaysia or wherever area that you live in. You don't find that many listed. and
not at all.
so much information.
Yeah.
Yeah.
Apart from the big three, big four, no one really knows who's the auditors actually and where they're located at, unless you are supposedly to find them for auditing.
Exactly. 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 Usually you find these people if you are a small and medium scale company by recommendation, right? But again, that also has an issue because just because one client recommends their audit firm to somebody else, the audit firm should not give any special advantage to the person who's recommending.
Yep.
Right. So yeah, the way that we found our auditors was that there was a like a very small classified ad saying accounting service providers, and one of was auditing, right? Accounts preparation, auditing, year-end accounts, blah blah. So very small advert. It was very anonymous. There was no logo, there was nothing, just the name. And then I just called them, and that's how I found them. So I didn't even know them before I even found them.
Okay.
I think that's obviously that should be the way, isn't it? I mean, if you know them, like if they are your friends, if you have some kind of a friendship with the lead person, or the owners of the audit firm, then that itself is going to violate one of the
Yep. It will go back to
independence.
the earliest rule. Yeah.
Yeah. All right. How are we doing with time? Okay. So then how do you obtain professional work? Accountants may advertise for work and engage in other forms of publicity, for example, by posters or hoardings, or on motor vehicles, on sportswear, or by sports sponsorship. Accountants may not give any commission fee or reward to a third party for introducing clients. There you go. Such commissions may, however, be paid to his employees or other practicing accountants.
Okay.
Right. Remuneration. How do they get paid? So the normal basis for charging professional work is on the time spent on the work, calculated at appropriate hourly rates.
Okay.
For whoever the staff that you use, right? So it's hourly rate. What that requires is for the auditor to really plan the audit and the times and everything, the workload and the people who are going to work. So it's a lot of project management. It's not a lot. I mean, it's good project management.
Okay.
So it's not a flat rate. It's basically an hourly rate. They're not permissible to charge on a percentage basis. Like they can't say, okay, we charge a percentage on your profit before tax, right? Or the amount of tax that we saved you, whatever, right? Except where statute or custom allows it. Example, in liquidation and receivership work. So if it is a liquidation thing, then maybe the statutory law allows you to get a certain percentage from the from whatever the amount that they receive as a result of liquidation, right, of assets. On a contingency basis, accountants cannot accept work on a percentage of tax saved, like I said, or anything similar, right? Because then they will try to save more and more tax just to get more money for them.
More commissions, yeah.
Yeah. Insider dealing is illegal. It's also contrary to ethical rules. People who during the course of their work come across unpublished price-sensitive information are prohibited from dealing in securities to which that information relates. So example is, if there's a listed company and it is in the market, it is expected to make about $10 million this year, but you're the auditor and you know you get the information firsthand that it's going to actually make 12 million. Now you have this information, and what you can do is you can actually buy shares of that company, because you know that when this information is published, it's going to have a share price increase. So you should not do it, and you should not use that inside information to make money for yourself, or pass that information to others who could potentially make money on that.
Okay.
Right. I mean, the idea is that inside information is that you're going to get inside information about the company, all kinds of information. It's not only the annual profits, right? All kinds of information, and you can use that information to benefit for yourself. And you know, if you pass that information to others, for them, like for competitors. So, but an auditor must never ever do that. So in a way, that auditors are kind of disadvantaged in the sense that even if they don't use inside information, but still if they are shareholders of some companies, people can question their integrity. Do you know what I mean? Then money laundering. So these criminals who earn monies through illegal activities, try to launder their money, clean their money, wash their money by passing that money through various, agencies and financial activities. And usually you find that these are done by, banks and accountants and lawyers themselves, right? They are the ones who help them do that. In Sri Lanka, of course, we are currently, right now, we are in the middle of something like that emerging. You know what tax havens, right? Tax havens, where there are some countries, they give huge tax relief for businesses and individuals. So what they do is they just they register a business entity in that country, and they pass their finances through that, right? So they basically they could issue invoices from that company.
Okay.
And when the money comes to that country will not charge any tax on that. Not charge any tax, but like negligible amounts of tax as compared to the income tax that they would have to pay in other countries, in their own country, for example. Like US companies will have companies registered in Panama and Cayman Islands and in Switzerland and wherever. Swiss bank accounts are very notorious for that, right? A lot of wealthy people have bank accounts in Switzerland because they don't divulge the information to others. And people use these kind of places to launder their money. So they they pass their money through accounts in those countries, and get it back and use them for all kinds of other legal activities. Now in Sri Lanka, we are having a big problem right now. A Chinese company built a new land by filling the ocean.
Okay.
Right, and it's called the port city in Colombo. And the current government is trying to get a legislation passed to say that all the business that's going to happen in that new land and will not be required to follow the laws of the municipal council, the board of investment, and the various acts that by, right? So clearly, it's, the government is trying to create a tax haven for in Sri Lanka, which is it's a heated debate right now in the country.
I think mostly it just created a shell company to just pass through that.
Exactly.
That money.
So
it's just a shell company, not a real business anyway.
So you know how it works. How is the situation in Malaysia?
Yeah, I kind of. It's not like really obvious, but I kind of see it through that some really have that kind of shell company. It's just for the purpose of passing it through so that you can get the tax relief, higher tax relief or something like that. But you are not really operating on anything. It's just for you to, for that purpose. But it comes with all the invoices and everything. But because it's small scale, so you don't really go for audits and none really knows exactly what's going on. But if you live around there, you kind of see there's no business coming in.
Exactly. And there are some people who are claiming that this is the turning point for Sri Lanka. We are going to be, a lot of money is going to come to our banks, and that money can be used for development projects, investments. Whereas others say, yeah, but that's not what's really going to happen. There will be financial restrictions from other countries, for example, and it's going to sort of suck out the money for other work, and people are just going to follow easy ways of making cash, and it's going to create more, widen the gap between the haves and the have-nots and all that.
Yep.
I mean, at the end of the day, if you're creating some special advantages to a group of people, then obviously it's not right. It's not ethical. So, in my opinion, I think it should not be the case. If at all, if the government really wants to attract investors, then what they should do is they should amend the existing laws and make it more easier, but not necessarily like allow money laundering and tax havens.
I think
they
not
should make it
be biased on one side, like obvious biasness over there if based on the story. I think like what you said, the amendment of the law should be equal applied to anyone, not just for that particular locations, but overall in Sri Lanka. Yeah.
Exactly, and make it very open and transparent.
Sure.
I mean, we are in the 21st century, and our generation, we are trying to be more ethical and more truthful, and prevent corruption. That's what we are trying to do. It's a new world that we are envisioning, but this kind of thinking is very old way of building economies, and it's not sustainable at all. But hey, this is what happens with governments, right? Particularly when governments are run by people who have Swiss accounts and who do money laundering themselves. This is what happens. They think that they can do it for the country as well. But anyway, so you understand money laundering, and auditors should be very, very careful and be vigilant of that. Are you familiar with whistleblowing, Kira?
Yep.
What's whistle? Yeah. So
basically a person who kind of tip off on that fraud information. So we call it whistleblower. By right, this person should be anonymous, and the information should not be disclosed in any investigations or anything.
Brilliant. So if any breach of law or regulation should be informed to proper authorities, especially if it is in public interest. But then you place the auditor in a very tricky situation,
Okay.
right? So the auditor will have to make a decision if the auditor discovers something like that. How should they go about it?
All right.
Now, there is some guidance on the standards that
Yeah.
there is some guidance, Kira, on how to go about it. Like for example, first thing is to inform the client that there is something like this happening, and that the right thing for the auditor to do is to inform the right authorities, but with the permission of the client. But sometimes the client will not give the permission. And then what should the auditor do is a question, right? So these are not very clearly defined things, right? But these are general fundamental principles or attitudes that the auditor will have to have in going about. So it's actually, at the end of the day, it's up to the auditor on what to do, right? So in such cases, the auditor should take legal advice because they should protect themselves. Discuss the matter with the board of directors, as I said earlier. Request the board to disclose the matter to the proper authorities. So not the auditor, they advise the board, the company, to disclose the information. If they fail to do so, inform the proper authorities themselves. Now that is the big jump, right? That is the whistleblowing part. And but hey, as professionals, you are bound with that burden. A few other matters. Descriptions of members of professional bodies and their designated letters. Activities through corporate and non-corporate organizations. The obligations of consultants. So here's an example. So Alan is an accountant. And he consults Bertha, who is also an accountant, but having some specialist knowledge on taxation. On behalf of Colin, a client. So Alan's client is Colin, but Alan does not have speciality on taxation. So he consults Bertha. Now Bertha should not then go and obtain work from Colin, the client, Alan's client, unless Alan gives her consent or 3 years has passed since that initial consultation or the engagement. Then Bertha can obtain work from Colin, right? Now this is a professional practice to prevent the fear of consulting each other, thinking that if I get some support from a fellow agency, that agency will then go and grab the client, right? So to prevent that fear, the accountants have this understanding of this sort of practice. Right? So corporate and non-corporate organizations, you understand that, so how you deal with corporate organizations and how you deal with non-corporate like charities and so on, and even government organizations. What are the different rules and guidelines that you need to use. Clients' money should always go to a separate ledger account. Like for example, now when when our company, when we want to pay income tax, that payment is handled by our auditors or the accountants. And what we do is we pay the accountant, and then the accountant pays the income tax department or the inland revenue. And so whatever the money that we sort of pay to the accountants, that money should go to a proper separate account, and then from that account they make the various payments. Right. So it's very clear the trail of payments. All right, running out of time. Here's a case study, Kira, for us to discuss. Philip has been in practice for many years. At the present time, he's anxious to develop more income to send his sons through university. Among the new ventures he has been offered are the audit of his brother's new company, the job of auditing, 25% share in a new company being formed by a client to market computer software, an agency with a building society who want him to agree to an illuminated signboard in his office window, a back duty case client has offered in if he will negotiate a reduction in the estimated assessment. George, his assistant, has been offered a part-time job by a company client, keeping the client's books. So the questions are, how might Philip enlarge his practice? How should he deal with the matters mentioned above? What are your thoughts? Kira, you need to unmute.
Sorry, I said it today. At first, I think he shouldn't take this audit's job at the first place because there is a lot of conflict of interest going on inside this at first that will make him be dependent, because he has the needs, and with the 25% shares, with him knowing these clients, it's actually go against all these ethics for the auditors. So I think he could be referring this person to another auditing firm, or which is another way not to take this into his hand, or he's not going to be the auditor for these clients.
Yeah, so what you're saying is maybe he can still take the 25% shares and be a shareholder of that new company, but then he will have to refrain from auditing that company. Yeah. And again, this is about sending his, getting income to send his sons through university. So maybe he's a little desperate, and maybe, getting 25% shares will require him to invest some money himself, him or herself, and that might not be a good decision. So you need more information to make a decision on that altogether. But what about this one? An agency with a building society who want him to agree to an illuminated sign in his office window, that he will. So he has his office window, and the building society's sign will be on his office window.
I think this one back to this advertising part, where basically for him, he should not be, be related or in relationships to any clients or company, even though this is just on the sign off window. Because for me, as my understanding, that auditors have to be neutral regardless of anything. They should not show it in the sense that, you are, even though you just are supporting a sign on window, but to the perspective of others, this actually shows that you in collaborations with these certain clients, even though you are not. But that perspective matters, because that can affect how their trust on and your integrity reputations. Exactly.
Very good. Unless if this agency is not his or client, it doesn't say that, right?
Yeah, but I think even so, it's still going to be risky for them, right? Because you wouldn't know who or when this could be your client. They're probably not your current, but in a way they could be your potential clients in the future. So
Yeah.
it will come back and hunt you back in no time.
It would, yes. So it looks like all of these are a no-go.
Yep. I don't think none of it can be applied for him to be auditors. He could take the share, definitely, yes, but George can keep the part-time job, but for him to be auditing all these 5 companies, I don't think so.
Yeah. So how do you think Philip can enlarge his practice?
If they say he would like to, he could actually advise maybe the clients to provide him recommendations of other clients or something like that. Yeah. That's one possible way that I was thinking of.
I mean, he will have to find new business, new clients.
Yes.
Yeah. That's the only way. Or maybe try providing services, additional services which they are not offering already.
Okay.
Right? It could be some examples. Okay, in the interest of time, I'm going to leave this case study for you to analyze. Okay. Because we need to at least start talking about the stages of audit.
All right.
Otherwise, I'm afraid we might not have enough time to go through everything. So, Kira, these are the different stages in an audit process, right? You can call them the audit process, the cycle, audit cycle, whatever, right? First important thing that any auditor would do is to do a thorough background research, right?
Okay.
And I mentioned this earlier as well, but they will need to have an understanding about the industry, the company's history, what are the current challenges, the present situation of the company. Are they doing fine? Are they going bankrupt? Are they losing money? Are they growing, right? And what are the future prospects? What are the future plans of that company? Where is the industry heading, and so on? What kind of products and services they offer? What are the different locations that they are based at? Then their accounting system. So they need to have an understanding about their current accounting system in whatever way, manual, digital, SAP, whatever. Previous audit reports, they need to study all of that. Then they need to have meetings with some of the key staff members in the beginning to get an understanding, and read any kind of published data that the company might have on their website, their previous annual reports, and whatever. And then with that really good understanding, they will start preparation of the audit plan, right? Now, the audit plan requires an outline of all the audit work that needs to be done on each area of the client systems and financial statements. This needs to be, Kiara, this is what leads to what we call the letter of engagement, right? So once you do that, once you identify all the work that needs to be done, that document needs to be signed off by the client, right? So that becomes that kind of becomes like your project charter, as we call it, or the letter of engagement. That's the work that you're going to do, and it will also clearly define what the work that you're not going to do, right? So that is important for you, because this is part of your risk management as well. So you have a question on audit risk, right? So when you identify the work that you are going to do and the work that you're not going to do, that will protect you from any risks, and it will help you to plan for the risks on the work that you're going to do as well. So once the report is published, and if some issue is found, then if that issue was outside the scope of your work, then you have basically protected yourself, right? Then you have to identify the staff who is going to do the audit, and the various bits and pieces of that of the audit, the various locations that you have to do the audit. You might have to visit certain sites, the timing of the work that needs to be done. So you need to have a time plan, right? And a budget for the time that is spent, and various other costs for your staff. And the plan must be made to fit in with the client's timing requirements and with the client's ability to produce necessary analysis and some summaries. So yeah, so like if you are planning to do some kind of a questionnaire, then that needs to fit in with the client's timelines as well, right? And all this, your entire audit plan should fall in line with the client's requirement of the audit report, right? And then what you're going to do is do what is called the accounting systems review, right? So there are like in the stages you see accounting system review, right? And internal control system review, right? So these two things kind of happen simultaneously, right?
All right.
We'll have a quick read. So you need to review the system by asking questions from the finance director, the accountants, and the staff, and so on, right? And you need to have all this information recorded on paper. And you need to corroborate the record by confirming it with data that is printed out of the system. Review for adequacy and for planning of tests. So we'll come to tests in a bit. Test to determine that it always works as it is supposed to, right? So what that means is that you are going to check the system, you're going to evaluate or review the system, accounting system, to see if it is capable of doing what it is supposed to do. Right? Like basic thing. Is the system recording all the transactions? Very simple, right? Or is the system recording all the assets and liabilities, right? Simple as that. So I mean, the system is supposed to do certain things, and you are checking if the system is doing that or not, right? Because okay, then you need to form some kind of a conclusion on the adequacy of the client's system against the statutory requirements, right? So if you are reasonably happy with the accounting system, then that's a good thing, because you know that your job is then easier because the system is good. Then all you need to do is check errors in the system, not go and chase every little transaction, right? Because if the accounting system is recording all the transactions, great. Then you don't have to check if all the transactions are recorded or not. Right. But hand in hand with this is what we call what goes hand in hand with the account system review is internal control review, right? So an internal control system is the whole system of controls, financial and otherwise, established by the management in order to carry on the business of the enterprise. in an orderly business. And so, like, I'll give you an example. The example could be something like, okay, I think I have a picture, right? Look at this, how the approvals work. And maybe you're very familiar with this kind of system. So you have the customer, the sales, the contracts, legal, and the fulfillment columns, right? So here's a flow chart. Customer submits the purchase order, right? The sales representative logs in the purchase order and enters the order into the system, right? And then the contracts agent reviews the order. If the standard terms are met, if it is yes, then the agent approves the order. If the standards are not met, if no, then the agent requests approval.
Okay.
Right? Because from a higher authority, right? Then the changes are if the changes are acceptable, then here it says attorney Mark is okay. You know, somebody who is responsible for, like, from the legal department says, okay, fine, this request can go ahead, and then it approves, it gets approved, right? And if the agent approves, then it goes to the order fulfillment, order is shipped, right? Now, if the changes are not acceptable, if the legal department says no, then the agent will cancel the order.
Okay.
The representative, the sales rep will be notified, order is not shipped, right?
Yep.
Now this is basically an internal control system for sales. Okay.
Yep.
So you will have these kind of processes and policies and systems, procedures, interdepartmental gates, right? For things to follow. Like, for example, if you take wages and salaries, if you're paying wages to daily laborers, right? There will be a process of calculating those wages, who approves them. It's not the same person who calculates and approves. Always two different people, isn't it? And then how do you get the money from the bank? In what form? In envelopes, whatever. Then who counts, right? Who counts that money? Then who disburses that money? How? And then some supervisor will supervise it. Then a manager will take samples, check samples for errors. What happens if somebody doesn't collect their pay package, right? What happens to that money? Where does it go? And what happens next? So all those things, these are called internal controls, right? So an auditor will check for these internal controls as well, right? And some of the things when it comes to the individual components of an internal control systems are known as controls or internal controls. Some of the areas that you have to focus on when talking about internal controls is the organization, segregation of duties, physical, like access keys, for example, like different people will have access keys to different units and different sections, right?
Yeah.
Who authorizes, who approves, the arithmetic, the numbers and the counting and the accounting side of it, the personnel, the supervision aspect, the management aspect, acknowledgement of performance, like signatures. So at every step of the way, somebody will have to put a signature.
Yep.
The sales rep will have to put a signature, the contract person will have to put a signature, then the cashier will have to put a signature, and then the sales order goes to the dispatch unit, and there somebody will have to put the warehouse person will have to put a signature, and even in most of the cases, finally the security guard will have to put a signature.
Okay.
Right. So this is called acknowledgement of performance. Like if you do something, you have to put a signature and confirms that you did that. Why? Because there is a trail, and if you find something wrong, then you can trace through this process,
Okay.
and find what went wrong, right? So these are these are different aspects when you're talking about when you consider internal controls, right? So an auditor, what the auditor will do is this. I think this process will help you. Appointment of auditors, fine. Plan the audit, so you plan it, and then you understand the client, the background check and everything. I mean, this can happen together. You do the risk assessment, fine, we'll talk about later. Assess internal controls as effective, right?
Okay.
So this includes the accounting system as well. If the accounting system and the internal controls are effective, yes, then you test the controls. If the internal controls are effective, okay, yes, test controls. Testing we'll talk next, right? How you test it, right? If the internal controls are effective, less substantive procedures. That means you don't have to go and hunt for every transaction, evidence for every action, because you rely on the system and the internal controls, right? If the internal controls on the system is not very effective, then you have to go like substantive testing.
Okay.
Right? So that's the idea here. The whole purpose of doing this this bit, internal accounting system review and internal control system, is for that. Right?
Okay.
Then the auditor's job is relatively easier. In either way, you still have to do substantive testing and analytical review techniques and analytical testing and all of that. You still have to do it, but the amount of testing that you have to do is less if the system is good.
Okay, understand.
That's the idea, right? So in your assignment, when you're talking about the auditing process and the plan, the central point that you have to focus is that.
Okay.
Right. So say that you will focus analyzing and reviewing the accounting system and the internal controls, and that you found that the internal controls are quite strong and quite good in most of the cases. Therefore, you depend on reviewing the system rather than actually going for substantive testing.
Okay.
And then you can say maybe in one area, like in the wages, or maybe in the procurement area, you found that the system is not that strong. Therefore, you had to go into in detail substantive testing.
Okay. All
right. Okay, so that brings us to we are with the time's up for us. It's 2:30 in Sri Lanka's time. I think we are okay with time. So tomorrow, what we're going to do is we're going to sort of finish up these techniques, right?
Okay.
And again, you're not going into detail on how to what are these techniques and so on. You just need to know that you have to do substantive testing and analysis. You're not going to get into detail of how to do statistical analysis or whatever, right? That you will probably learn in some other module.
Understand.
So we do that, and then we move into we'll finish off with audit risk and the connection between accounting systems and auditing.
All right.
Because there's one question on that.
Okay.
So that will sort of cover up the module tomorrow. So I hope today was useful, new information for you.
Yes.
And it will help you in your assignment work, Kira.
Yep.
If you have any questions, just mark them and keep them for tomorrow.
All
so
right.
that we can clarify them while we are doing it tomorrow. So
Sure.
with that, let's wind it up. See you tomorrow, same time.
All right.